Welcome to this webinar where we will be discussing target date funds and specifically the Vanguard target retirement funds. My name is Josh Hitzo and I'm a co-founder and partner of Greenspring Advisors. We were named the 2018 Plan Sponsor Retirement Plan Advisor of the Year, and we are the fiduciary advisor to your retirement plan. We work very closely with your retirement plan committee to provide strategic oversight and fiduciary management for your plan. And we also provide financial counseling and fiduciary advice to you as employees and participants in this plan. My goal today is to give you a basic understanding of how target date funds work, who they are best suited for and how to use them properly, and educate you about the Vanguard options in your plan, as well as share some of the resources that we make available to you that you can take advantage of. Before we begin, it's important to note that the information in this presentation has been obtained from sources we consider reliable, but its accuracy and completeness are not guaranteed by Greenspring Advisors. This material has been prepared for information purposes only and is not a solicitation or an offer to buy any security or any instrument or to participate in any trading strategy. And always remember that past performance is no guarantee of future results. When it comes to investing in your retirement plan, there are typically two approaches you can take, which we like to describe as cars versus car parts. The first approach is like building a car and requires you as the investor to choose from the various funds in your plan and to assemble them into a diversified portfolio that's suitable for your individual goals, needs, and preferences. Once you've assembled your car, it's your job to make sure that you take care of the ongoing maintenance, like changing the oil and rotating the tires so it can run smoothly and for a long time. In investing speak, this means periodically reviewing your portfolio to make sure it's still meeting your needs and being disciplined about rebalancing your account when certain investments become overweight or underweight based on the performance of the markets. It needs a more hands-on approach that requires consistency and discipline, and it's typically suitable for the do-it-yourself investor. The second approach involves buying a target date fund, which is a professionally managed option that is invested according to your age and projected retirement date. All the decisions about which investments to select and when and how to rebalance are taken care of for you. It's like buying a pre-assembled car that includes the ongoing routine maintenance as part of the price and is better for the investor who prefers professional management and a do-it-for-me approach. Our research into our own client base shows that only about 20% of employees prefer to build their own car, and 80% are more comfortable buying a car that's ready to drive. We also see very similar data throughout the industry. According to a Fidelity survey, 8 of 10 participants said they didn't have the skill, will, or time to manage their investments. And yet, upon further analysis, 6 of 10 participants were invested as do-it-yourselfer investors, but hadn't sought guidance or made any changes to their portfolio in 2 years or more. Clearly, there's a major disconnect, which is why many do-it-yourselfers have unsuccessful investment experiences. In 2008, I wrote a book called Fixing the 401k, and I cited a longitudinal study done by Burgess Associates from 1997 through 2006 that compared the returns of approximately 15,000 participants who invested on their own versus those who used a professionally managed option like a lifestyle fund or a target date fund. Those in the professionally managed options earned 1.9% higher returns per year over the 10-year period than do-it-yourselfers, and ended the period with an average of 11% higher account balances. Also, nearly 85% of do-it-yourselfers would have been better off in a professionally managed portfolio. The data on this chart from JP Morgan shows the period covering 2008 to 2011 and is just as compelling. Most investors get themselves in trouble by doing the wrong thing at the wrong time. JP Morgan evaluated target date fund investors across their client base during this particularly difficult time period as compared to do-it-yourselfers using core menu funds and self-directed brokerage accounts. There's a couple of important things here to highlight. First, on average, target date fund users had returns of more than 2% higher per year during the period than do-it-yourselfers. More importantly, from my perspective, look at the range of returns. The analogy I always use is when I took my daughter to a kindergarten birthday party at a bowling alley, and they put up bumpers for the kids so they would not throw gutter balls and they'd have a fun and successful experience. While target date funds might not be the right solution for everyone, we believe it's the best possible investment solution for the vast majority of participants when you look at the evidence of how do-it-yourself investors tend to do on their own. Once you've chosen to use a target date fund, it's very important to use it properly in the way it was designed. This means investing 100% of your current account balance and all your future contributions into a single option. According to Vanguard, only 26% of participants who participate in a plan where they need to sign up on a voluntary basis and choose a target date fund actually utilize it properly. In contrast, nearly 85% of participants utilize target date funds correctly when they're automatically enrolled and defaulted into a target date fund without having to make a decision. A target date fund is designed as a one-stop investment strategy with a specific diversification strategy, commonly known as the asset allocation of the fund. It basically means what percentage of your portfolio is invested in stocks versus bonds. When you invest in multiple target date funds or a target date fund plus other funds, you may think you're achieving diversification, but in reality, it will throw your portfolio's overall asset allocation out of whack and potentially expose you to too much risk or too little risk. So make sure that if you choose a target date strategy, you use a single target date fund. As an investor, one of the most important tools at your disposal is diversification. It's been described as the only free lunch in investing, and we advise clients to take as big of a helping as possible. What you will see is that the Vanguard Target Retirement Funds invest in 5 to 6 underlying funds, which include the Total Stock Market Index and Total International Stock Market Index, both of which are stock funds, as well as the Total Bond Market Index, the Total International Bond Index, and the Short-Term Inflation Protected Securities Index, which are all bond funds. The beauty of these target retirement funds is that they automatically invest your money in more than 20,000 different securities around the world, so they are incredibly well diversified to help you manage risk. Here you will see how the different funds in the Vanguard series are invested across these underlying funds, and I want to point out a few important things. First, the Vanguard Target Retirement Series actually has 12 different funds to choose from, generally broken down in 5-year increments, which correspond to your birth year and the projected year you'll turn 65. For instance, if you were born between 1973 and 1977, like me, the target date fund that most closely matches our projected retirement date is the 2040 fund. If I was a participant in your plan and decided to use a target date fund, this is the one I would select, and I would invest my entire account balance and all my future contributions into this single option. This chart also shows how each of these different funds is invested across the 5 to 6 underlying funds. Target date funds have what's known as a glide path, which simply refers to how the percentage invested in each underlying fund changes as you approach retirement. What you'll see is that the 2045 fund through the 2065 fund are all basically identically invested with about 90% in stocks and 10% in bonds. That's because investors who are projected to turn 65 many years from now have a long time horizon to invest and can withstand more volatility and the ups and downs of the market more than someone who is near or currently in retirement and doesn't have as much time to recover from potential losses. Beginning with the 2040 fund, you start to see the total percentage invested in stocks begins to decrease with each 5-year increment, and the total percentage invested in bonds increases until the 2015 fund, which has about 40% invested in stocks and 60% in bonds. The last option is the income fund, which has approximately 30% in stocks and 70% in bonds, and this fund stays invested this way on an ongoing basis. Every 7 years after the target date, the last option that includes a year is merged into the income fund and goes away. For instance, in 2022, the 2015 option will be merged into the income fund, and the 2020 fund will become the next to last option. Also, every 5 years, a new fund is added to the series. So in 2020, a 2070 fund will be available for the newest entrants into the workforce. I'd like to highlight a couple of more things. First, you will see that the ratio of U.S. stocks versus international stocks is 60% to 40%, and this is consistent throughout the whole series. For instance, the The 2020 fund only has a total of about 53% invested in stocks, but 31.6%, or 60% of that total amount, is invested in U.S. stocks, and 21%, or 40% of that total amount, is invested in international stocks. Also, the last three funds in the series, that is the 2020 fund, the 2015 fund, and the income fund, start to invest in increasing amounts in the short-term inflation-protected securities index, which are government bonds that are adjusted for inflation to help maintain purchasing power in retirement. This chart is simply a visual representation of the glide path for the Vanguard series, where green represents the percentage invested in stocks and the dark gray is the percentage invested in bonds, and how the ratio between the two change over time as retirement approaches. One of the most beneficial aspects of the Vanguard options is that the fund fees or expense ratios are incredibly low, especially as compared to industry averages. When it comes to mutual fund performance, there's actually an inverse relationship between costs and outcomes. For example, in a 2010 research report, Morningstar said the following: "If there's anything in the whole world of mutual funds that you can take to the bank, it's that expense ratios help you make a better decision. In every single time period and data point tested, low-cost funds beat high-cost funds. Expense ratios are strong predictors of performance. Investors should make expense ratios a primary test in fund selection. They are still the most dependable predictor of performance." On the bottom part of the chart, we've listed the expense ratios as of December 31st, 2018 for different share classes of the Vanguard funds, including the investor share and the institutional shares and the retirement trusts, which are slightly lower cost versions but still invested and managed in the same way. The institutional shares and retirement trusts are generally only available for very large plans that meet eligibility requirements or where Vanguard is the record keeper. If your plan uses a record keeper other than Vanguard, you will most likely have the investor shares. But whichever share class is in your plan, the total costs are incredibly low and rank in the top 5 to 10% versus the Morningstar category average, which gives you a great leg up from a performance standpoint. To give you a sense of the real-world cost to own these funds, this chart shows the annual dollar cost of each share class of the 2030 fund versus the Morningstar category average based on different account balances. To get the dollar cost of owning a fund, you multiply its expense ratio by the total amount invested in the fund. For instance, the 2030 investor share has an expense ratio of 0.14%, which when multiplied by $10,000 equals $14. That's the estimated cost to own the fund for every $10,000 invested in it. If you had the institutional share, you'd pay $9 per year. By point of comparison, if you own the average target date fund in the marketplace as tracked by Morningstar, you'd pay $81 for each $10,000 invested. With a $100,000 account balance in the investor share, that cost savings is $670 per year, which is going right back in your pocket in the form of higher returns. At a $1 million account balance, the difference is $6,700 per year. Make no mistake, costs matter in a big way, and the Vanguard funds are about as good as you can get within the industry, which is partly what makes them so popular. As I mentioned at the outset, we are the fiduciary advisor to your plan. Clarity at Work is our dedicated financial wellness plus fiduciary advice platform that makes it easy for you to get the unbiased and objective fiduciary advice you need in a simple and efficient way. Clarity at Work combines on-demand access to a certified financial planner, along with digital tools for retirement planning, budgeting, and debt management, as well as 70-plus articles and 125-plus videos on various financial topics. To get help, simply visit www.greenspringadvice.com, click Login, and sign up for the platform with your company email address, and take the first step towards achieving retirement clarity.